Hello, good day, everyone. This is Dr. Don Charles, and welcome to my video series in a practical introduction to day trading. So this is my first lecture. In this lecture, we will cover what are assets, what are the different types of assets, what is a financial exchange, what are financial assets, who trades financial assets, what is trading, and how it is different or distinct from investing, and what is speculating. So we will start first by looking at assets. What is an asset? An asset is something that you own. There are different types of assets. There are physical assets and there are financial assets. Physical assets are assets that you can touch. For example, a car. You can own a car and you can touch a car. Another example, a house is an asset. You can own a house, you can touch a house. Another example, the electrical equipment in a house. For example, a television, a microwave, a blender. All these things are assets. These are things that you can touch. These are things that you can own. These are assets. There are also financial assets. Financial assets are somewhat abstract in the sense that you cannot touch them, but you can own them. There are different types of financial assets. So the first financial asset I will refer to is a stock. A stock represents a unit of ownership of a company. Stocks are also called shares. There are different categories of stock. There are common stock and there are preferred stock. Common stock are stock with voting rights. So common stocks represent some form of ownership of a company, and owners of common stocks have some form of voting rights of a company. In other words, they can vote to decide who will be the members of the board of a company. Preferred stocks generally do not have any voting rights. However, owners of preferred stock usually get dividends. Dividends here referred to as the interest generated from the stock. Preferred stocks generally pay out dividends before common stock. Well, that's just textbook examples. In real life, some people that own common stock also own preferred stock. So the owners of some common stock own preferred stocks. So in effect, they have voting rights and they expect to be paid dividends. The owners of stock generally own some share or percentage of a company. They are the owners. The owners of common stock have voting rights and they can vote for the board. They can determine the board who will be responsible for coordinating the policy which set the direction for the company. Generally, owners of stock own some share of a company and they expect to be paid dividends. They expect to be paid their interest. They expect to get a return from owning of a stock. Stocks are assets. Another type of financial asset is a bond. Bonds are debt instruments. They are issued by a government or a government agency. Each bond has two components. One is a par value, which is the principal or the amount you pay to get the bond. The second component of the bond is the coupon. The coupon is the interest. Bonds typically have a maturity date. So a bond is a loan instrument issued by a government to the holder of the bond. So when you buy a bond, you buy the bond from the government. You pay the par value for the bond and the government gets the par value as a loan. However, there's a contractual promise for them to pay you back the entire principal of the bond upon maturity, as well as whatever interest or coupon that is outstanding. These are bonds. Bonds are debt instruments. Bonds are also assets. The second type of asset is called a currency pair. A currency pair is also called a foreign exchange or forex. This is the same as the exchange rate. For example, the euro USD. This is a currency pair. It represents the ratio of one country's currency to another country's currency. Let me show you an example. This is a currency pair. This is a euro USD. It shows the exchange rate of one country's currency to another country's currency. I am showing you here a diagram, a chart of the price of the euro USD. You can see that the price of the euro USD changed over a period of time. So it went down over a period of time and then went up. This might seem very technical, but do not worry. These charts will be explained in greater detail in a future lecture. However, for this video, I just want to emphasize that a currency pair, also called a forex, is a type of financial asset. Another type of financial asset is a commodity. There are many types of commodities. There are agricultural commodities, there are metal commodities, there are energy commodities. Agricultural commodities refer to primary agricultural products. For example, wheat, sugar, corn. These are examples of agricultural commodities. Metal commodities include metals such as iron, steel, platinum, and tin. Within the metals category, there is a subset of metals called bullion. This includes precious metals, for example, gold and silver. Then there's also the energy commodities category. Energy commodities include commodities such as crude oil and natural gas. Another category of financial asset is derivatives. Derivatives, there are multiple derivatives. There are futures, there are forwards, and there are options. A derivative is an asset that gets its value from another asset. In other words, there is a base asset called an underlying, and it is used as a reference point to compute the value of another asset. So I will explain the first type of derivative. The first type of derivative is called a forwards contract. Now, a forwards contract is very similar to a futures contract. In a forwards contract, an economic agent sells an asset now. However, there is a contractual obligation for the economic agent to deliver the asset to the person that purchased the asset at a future date. Let me give you an example. There can be a forwards contract for oil. Oil right now is trading at approximately $60. So if someone sold a forward contract for oil, they would receive $60 now. However, they will have a contractual obligation to deliver the barrel of oil at the future date. So if it was a 3 months forward, they would have a contractual obligation to deliver the barrel of oil to the person that purchased the oil at 3 months in the future. This is generally how a forwards contract works. Future contracts are very similar to forward contracts. However, the only difference is that with a futures contract, there is no actual delivery of the commodity. When the date of maturity comes, there's usually a liquidation of the contract. An option gives an economic agent a right to buy or to sell back the asset at a preferred price. Let me give you an example. Suppose an economic agent is in the business of selling oil, and they anticipate the price of oil can decline. So assume now the price of oil is $60, and they anticipate the price of oil can decline to $20 in the future. Assume that the point in time in the future is 2 months from now. So if the price of oil declines from $60 now to $20 in the future, then the seller will lose $40 on the market. Well, that $40 will be an opportunity cost. The seller can hedge against that risk by trading an options contract. They can purchase a put option. A put option is where they can execute terms where if the price of the asset moves in unfavorable direction, they can execute the put and they can sell the asset at a preferred price. For instance, if the price drops from $60 to $20 and they execute the put at $55, they will minimize the potential loss that they would have made if the price of the asset declined from $60 to $20. That's generally how options work. There are put options and there are call options. So we can also have a buyer. A buyer might be interested in purchasing a commodity for use. However, they anticipate the price of the asset could increase in the future. They may purchase a call option. In the call option, if the price of the asset rises to a higher amount, they will have the right to execute the call so they can buy the asset at a preferred price. So, for example, assuming another economic agent was anticipating the price of oil could rise from $60 to $100, so they may buy a call option. So, if the price of oil rises to, let's say, $100, they might implement their call and they might buy the oil at approximately, let's say, $65. Yes, $65 is higher than $60. However, it is still lower than $100. So it is better for them to buy the asset at $65 than to buy at $100. This is generally how options work. Options have a call and options have a put. Now, there are other types of assets, such as indices and cryptocurrencies. Indices generally track the performance of multiple stocks. Cryptocurrencies are a new type of asset. These are digital currencies, such as Bitcoin, Dogecoin, Ethereum, and so forth. Cryptocurrencies are not legal tender. They were not issued by any generalized monetary authority. Nevertheless, cryptocurrencies are traded on financial markets, and cryptocurrencies are also used to facilitate transactions. In other words, they are used as tender to facilitate the trade of goods and services. So, next thing I want to speak about is a financial market. What is a financial market? A financial market or an exchange is a market where different assets are traded. There are many different types of financial exchanges. Each type of financial exchange facilitates the trade of different types of financial assets. One of the most common types of financial exchange is called a stock market. For example, we have the New York Stock Exchange, we have the London Stock Exchange. These are common financial markets. These facilitate the trading of stocks. But you can also have a bond market. A bond market is a distinct type of financial market. This facilitates the trading of bonds. There's also the currency pair market or the forex market. The currency pair market facilitates the trading of different currency pairs. Currency pairs, as you mentioned previously, are exchange rates or forex. There's also the derivative market, which facilitates the trading of derivatives. We mentioned previously that the derivatives include futures, forwards, and options. Now, in this course, we will focus specifically on the forex market. However, at different points in time during the course, we will also speak about stocks because the analysis which is intensely applied to the forex market can also be extended to the stock market. So the Forex market is separated into three major peak activity sessions. The main sessions are the Asian session, the European session, and the North American session. Some people refer to the Asian session as the Tokyo session. Some people refer to the European session as the London session. And some people refer to the North American session as the New York sessions. These are because these are popular exchanges on these markets. So the different sessions have different times. The Asian session operates from 11 p.m. to 8 a.m. That's Greenwich Mean Time, GMT. The European session operates from 7 a.m. to 4 p.m. And the North American session operates from noon, midday to 8 p.m. So now that we have established what are assets, and now that we established what are financial markets, I want to speak about investing. So many people claim that they teach you how to invest, but they are not teaching investing. They are really teaching trading. What is investing? Investing is a practice where an investor purchases a financial asset and holds the asset. They try to make a profit from the interest that is paid from the asset over a period of time. So the type of asset that an investor will trade will be stocks or it will be bonds, in the sense that they buy the asset, they hold the assets, and they try to make a profit from the interest paid by the asset. So in the case of the stock, the interest paid by the stock is called dividends. In the case of the bonds, the interest paid by the bonds is called a coupon. An investor holds the asset over a long period of time, and they try to make a profit over that long period of time from the interest. Some investors hold another type of asset called a mutual fund. A mutual fund is a portfolio. It is a group of assets. Usually, the assets in a mutual fund are stocks. So generally speaking, a mutual fund may be a group or a collection of stocks. Investors also purchase mutual funds because these mutual funds tend to pay an annual return over a period of time. Investors typically make a return of roughly 3% to 5% in a given year. Investing is typically associated with low risk, in a sense that is a low possibility the investor will make a loss. It will generally give the investor a profit or an annual return of 3% to 5% every year. Investing is distinct from trading. So you might ask, what is trading? Trading is a practice where the trader is an economic agent. Trading is a practice where the trader purchases a financial asset with the objective of selling the asset to make a profit. In other words, the trader realized that the price of the asset fluctuates, the price of the asset changes, and they try to make a profit from a change in the price of the asset. The price of the asset can go up, the price of the asset can go down. But regardless of which direction the asset goes, the trader tries to trade in the correct direction of the price of the asset and tries to profit off changes in the price of the asset. This is trading. Traders typically hold for short periods of time and profit from changes in price. In contrast, investors hold for long periods of time and profit not from changes in price, but rather from the interest or dividend paid from the asset over that period of time. Trading is distinct from investing. It is not the same thing. Investing, the economic agent buys and holds. They hold the asset over a long period of time. They hold for a year, they hold for more than a year. Traders do not hold for long periods of time. Traders buy and sell quick. They try to get in the market and make some quick money off changes in the price of the asset. An investor tries to make a profit of roughly 3% to 5% on an annual basis. A trader tries to make that profit of 3% to 5% in one trade. They manage their risk by by holding their trades for a very short period of time, and they trade very volatile assets. They trade assets whose price tend to fluctuate a lot, and they profit from changes in the price of the asset. Now, there are different types of trading styles. There's day trading, there's position trading, there's swing trading, and there's scalping. So you might ask, what is day trading? Day trading is a practice where the economic agent buys and sells the asset within a day. The economic agent here we are referring to is the trader, the retail trader. They buy and sell the asset with the objective of making a profit from the change in price of the asset in a day. So in other words, if they buy in the morning, let's say they buy at 10 o'clock in the morning, they will try to get off the market before the end of the day. They might try to get off the market by, let's say, around 4 p.m. I just use this as random times as possible times where the trader can enter a trade. So day trading includes short-term trading. The trader gets on the market, they make their trades, they make their profit, they get on the market quickly. Swing trading is where the trader tries to capture gains from changes in the price of the asset that ranges from several days to several weeks. Position trading is where the trader may hold for a longer period of time. They may hold for weeks, going into a few months. Scalping is where the trader tries to profit from small changes in the price of the asset, and the trader holds for a very short period of time. They may hold for a few minutes to a few hours. So scalping, a trader that engages in scalping also engages in day trading. However, they may not hold for a whole day. They may hold for a few minutes. They may hold a trade for maybe 5 minutes, 10 minutes, 20 minutes. They try to profit off small changes in the price of the asset. So I have here, these are the different trading styles. We have day trading, we have position trading, we have swing trading, and we have scalping. I also want to go on to speculating. What is speculating? Speculating is a practice where an economic agent realizes that the price of the asset could change, and they try to profit from the change in the price of an asset. Does that definition sound similar to retail trading? Well, retail trading is actually a subset of speculating. So speculating refers to a practice where an economic agent buys and sells an asset to make a profit from a change in the price of an asset, but they are not interested in an asset. It is in contrast to a thing called hedging. So with hedging, an economic agent is interested in an asset. However, they try to offset the adverse movements and changes in the price of an asset by trading a derivative. So I can use the same example with oil. So in the case of oil, a company may be an oil company, and they may anticipate the price of oil might decline. So if the price of oil declines from its current price at, let's say, $60 to a lower price of, let's say, approximately $20, then there will be a loss. This loss will be an opportunity cost, and this loss is approximately $40. However, the economic agent, in this case, the oil company, can hedge against oil prices. They can hedge against the adverse movement in oil prices, and they can hedge with a forward contract. If they hedge with a forward contract, they would receive money for oil now. However, they will have a contractual obligation to deliver the oil at a future date. This is hedging. In contrast, someone can trade a futures contract for oil. They can sell the futures contract for oil now. Let's say they could sell at approximately $55, and they can anticipate the price of oil can decline. If the price of oil declines from $60 to $20, and the price of the futures follows also, and the price of futures declines to a price lower than $55, then the speculator can make a profit. That is speculating. The speculator has no interest in the actual commodity. They realize that the price of the asset can change, and they try to profit off changes in the price of an asset. That is speculating. Retail traders also engage in speculating. They realize that the price of the asset can change and they try to profit off changes in the price of the asset. However, they have no interest in the asset itself. So retail traders and people engaging in retail trading, they are speculating. So I have here what is hedging. I just shown you a slide, but I'm not going to explain this in detail because I spoke just now there about hedging. So the last thing I want to mention today is the different types of economic agents that participate on a financial market. So the first type of economic agent I have here is a retail trader. A retail trader is an individual. It is an individual that trades the financial market. The second type of economic agent is an institutional trader. The institutional trader is like a company or a large organization that trades the financial market. The institutional trader tends to have a large capital base. They enter trades that are millions of dollars. In contrast, the retail trader has a very small capital base relative to the institutional trader. The retail trader might implement trades that have a few $1,000s or a few $100s. In contrast, the institutional trader might implement trades that are thousands of dollars to millions of dollars. The institutional trader has a very large capital base. In contrast, an investor is someone that invests. An investor can be an individual or an investor can be an organization. However, the investor invests. The investor does not try to make a profit from small changes in the price of the asset. The investor tries to make a profit from the dividend or the interest that was paid by the asset over a period of time. The last category of economic agent that we want to consider on the market is a hedger. The hedger is someone who is actually interested in commodity. However, they do not want the commodity price to move in an unfavorable direction. So they hedge with forwards contract or they may hedge with an options contract. So this will bring me to the end of this lecture today. Stay tuned for more. Thank you.